Good morning, everybody, and welcome to our July 2025 webinar run by the IFRS Corporate Reporting team here at BDO. Today's topic is accounting for financial liabilities. I'd like to welcome Kevin. He's here today. Kevin, how are you?
Dean, I'm wonderful and you. It's good to see you again, and wonderful to be back at the monthly webinar. Good to see everybody.
Good to see you, Kevin. Yeah, look, I think it's going to be a really interesting topic. I think we've had some interesting examples to talk about in this, covering on this area over the last couple of 6 to 12 months. So I think it's going to be some good material covered. We'll get straight into it, given that everyone's now online. Firstly, obviously, we want to acknowledge the traditional custodians of country throughout Australia and their connections to land, sea and community. And we pay our respects to their elders past and present, and extend that respect to all Aboriginal people and Torres Strait Islands people on the call today, and also working within BDO. Quick update on our corporate reporting webinars. At the moment, we're obviously doing the accounting for financial liabilities. Coming up, we've got some certainly some interesting topics. Accounting for technology and software costs is the August webinar, and 17th of September, we've got the tricks and traps of impairment testing. I assume you're going to be involved in that one, Kevin?
Oh, always, you know me, impairment to me is like leases to a letter. It's one of my favorite topics, so absolutely.
I saw the topic and I thought, oh, there's definitely going to be Kevin's going to be involved in that one, so that's going to be good. Also, carbon credit units, financial sustainability update for the end of the year, and then tricks and traps of fair value measurement. Sustainability webinars, coming up in July, the end of this month, Mastering AASB 2 S2 Pillar 3, Climate Risk Management Made Easy. Kevin, did you want to say anything about the other sustainability webinars?
Yeah, look, only that to remind everybody that we structured these webinars this year essentially around the four pillars in the sustainability reporting standard, or the climate disclosure standard, AASB S2. But that we are also moving into things like data management, and operationalizing some of the carbon stuff. So you'll see that coming in terms of tracking carbon footprints, setting and tracking climate targets. We're going to start to talk about the operational sides of that, which is obviously what happens once you get past the embedding of the, shall we say, the technical requirements of the standard. Obviously, you'll have to operationalize that, embed that in your organization. So we'll start moving into that sort of theme setting as we build the series out for the rest of the year. That's it.
Great.
I might just do the next two slides because they're in the
Mm.
same area, Dean, and that is to just remind everybody that we do actually have our virtual carbon masterclasses scheduled for the year. I feel as if the carbon accounting masterclass has almost become an industry standard. It's getting a lot of play out there. We're getting a lot of requests for it. And so, get your registrations in early on those ones. These two are virtual, taking us through to the end of the year. But I'm sure there may be something in the works for 2026 as well. And linking to that in the next slide, Dean, is our climate-related disclosures. Reminding everybody on sustainability reporting, and I don't think it comes to anybody as a galloping shock that climate-related disclosures is the big topic of this year, and it will be the big topic. It is still reporting. So even though we have a financial reporting or an IFRS webinar series, which is this one, and the sustainability reporting, it's all about corporate reporting in the annual report. So the two go together. Obviously, sustainability reporting is the new kid on the block, climate reporting. Why we have this disclosure checklist is the Group 1 December year ends are running very fast towards their first reporting year, which is December 25. And so we have this checklist that we've made available on our website, which essentially can help you um, not only identify gaps, but also to prepare for things like audit readiness. We've actually designed this checklist slightly differently to just a checklist. We haven't just taken the things out of the standard. We've turned the disclosure requirements around ever so slightly and pivoted into a way that asks the question about disclosure that can also help you consider things like, are you actually audit ready for it? So I do think it's one of our um, star tools out there available, and it is available on our website. So please download that. Thanks, Dean.
Thanks, Kevin. So we'll kick off and have a look at some of the liabilities and financial liabilities. For the next couple of slides, what I've tried to do is, and it might feel like we're going a little bit back to the future, but what I wanted to do is perhaps respond not to anyone particular's comments on financial liabilities, but maybe sort of a lot of some discussions that we've sort of been involved in the last 12 months where various parties talk about liabilities, and sometimes the precision of the discussion is not as possibly as good as it could be. We always think about accounting, we think about definitions and scopes, because all of those things are important to understand what are the applicable requirements. If we don't define something, or if we don't identify something correctly in accordance with its scope or its definition requirements, there is the very strong possibility, if not like very high likelihood, that the accounting is going to be wrong, because every accounting standard has slightly different accounting requirements. It's definitely measurement requirements, recognition, timing, and also disclosures. So what I wanted to do today was just to sort of step back through the definition of a financial liability, but compare it to how it's structured compared to other definitions of other liabilities, and get a sense of sort of what are the precise things we're talking about, and making sure that we're sort of clear in our communications around what we're dealing with, particularly in that financial liability world. So start from the very basic. We'll start with the conceptual framework. The definition of a liability: present obligation of the entity to transfer an economic resource as a result of a past transaction. It's a really common definition. We see it all the time. And most people who've done an accounting degree would have seen it and understand it. It makes sort of common sense to them. The interesting thing is that when we move then to provisions, which are a form of liability, the definition is not quite the same. And if we think about, and if I planned in your mind the bit of a provision, let's just think about a make good provision that you have, that at the end of a lease agreement that you have to paint the building, for the sake of an example. So if I look at AASB 137, it defines a provision as a liability of uncertain timing or amount. Okay, that's good. Uncertain timing amount gives me an idea about something to do with the valuation aspect to it, or the recognition aspect to it. But then it goes on to define a liability slightly different to the conceptual framework, and says a liability is a present obligation of the entity arising from past events, the settlement of which is expected to result in an outflow from the entity of resources embodying economic benefits. Now, it's interesting in the standard, the standard set has said, look, we haven't updated this definition of a liability for the update to the definition in the conceptual framework, and there's a very intentional reason for that. So when you think about provisions, often provisions can be things which you can satisfy either by asking someone else to satisfy it for you, or paying them to do that, or using your own resources. And so not always is the case with a provision that you'd necessarily, as the conceptual framework sort of anticipated, would you necessarily transfer an economic benefit or economic resource to somebody. You might actually use some resources that you have. And so as a consequence, if we defined in provision standard, if we defined the liability very narrowly, to just simply to transfers, you would find that there would be very few provisions actually recognised. A lot of entities satisfy provisions by actually doing the work themselves. If you think about the example I gave before about make good provision, if I go out and buy some paint and I do the painting myself, I haven't necessarily transferred any economic resources to anybody to relieve me of the obligation. What I've done is I've used some resources available to me, but I no longer have them available. Obviously, when I use the paint, I can't use it again. It's on the walls, and so it's gone. But it also means is that I haven't transferred something. So my provision is not necessarily something that involves a transfer. And the reason I raise that is because it's helpful to understand then what are the features of all provisions which are relevant to distinguishing them from financial liabilities. And so I've listed some of them there. So if you look at the definition of a provision, it says nothing about the basis for the obligation. So it could be legal, contractual, customary. Typically, it's legal or customary. Typically, only contractual liabilities are the financial liabilities, and we'll come back to that. The outflow or the transfer of economic benefits is not specific. It could be cash, it could be other assets, you could incur costs, you might pay somebody in kind. There's lots of ways you could satisfy the obligation. The outflow of the transfer of the economic benefits could be a party other than the counterparty. So I might, for example, ask somebody, for example, another painter to go and actually do the work. So it's not necessarily the counterparty that I'm necessarily transferring or providing economic benefits to. I mentioned before examples of make good provisions, obviously things like, example of provisions of make goods. It could also be a prospective fine or penalty, or could be just a warranty that can't be purchased, so that comes with the product that you've sold. And excludes trade payable. Importantly, it excludes trade payables and accruals. principally because the timing and amount of those types of liabilities is usually known. So they're not usually going to be able to meet the criteria of a provision in AASB 137. Now, if we move then to different types of liabilities and we move into financial liabilities, I'm not going to read out on this slide. It's way too much. And I've really just provided it as, to give you sort of an understanding of how big this definition is. And so what I'm going to do is break it down and look at the various components in it. So starting with the first component there, a financial liability is any liability that is a contractual obligation to deliver cash or another financial asset to another entity, or to exchange financial assets or financial liabilities with another entity under conditions that are potentially unfavourable to the entity. So compare it just on that basis, compare it now to the provision. You can see that this is a very specific type of liability. It's a liability that is contractually based, so it's not based on anything other than contracts. Now, I've mentioned in there in the right-hand side of the slide there, I've used and possibly abused the definition of a contract in AASB 15 to sort of demonstrate what we're talking about here. So in 15, an agreement between two or more parties that creates enforceable rights and obligations is seen as a contract under AASB 15. Enforceability of the rights and obligations in contracts are a matter of law, so contracts can be written, oral, or implied by an entity's customary business practices. Now, that's a definition in 15, and like I said, I've used it in a way to demonstrate what we're talking about here. Typically with financial liabilities, you don't necessarily see them all. In fact, there'd be very few of them that would be customary or oral, as a basis for that agreement. Typically, financial liabilities are written agreements because that is often how it's the most convenient way to convey what the restrictions, the rights and obligations are around those things. And because it's so specific to cash and it's specific to financial instruments, we find that most of those agreements that would fall into the category of financial liabilities are written. So it could be oral, it could be, a customary, but typically financial liabilities are written because of the nature of them. The second point I just want to raise there is that it requires the entity to deliver cash, another financial asset, or exchange financial assets or financial liabilities. Now, again, contrast that to a provision. A provision, there was no discussion in the definition about how the provision could be satisfied or settled. It could have been, I could have spent money, I could have given somebody money, I could have given them financial instruments, or I could have just done something. So with regards to when comparing to financial liability, a financial liability is very specific. It's going to be settled as a consequence of delivery of cash or another financial instrument. Is there anything you wanted to add there, Kevin?
Yeah, look, I think that's a wonderful summary, and sometimes I wouldn't mind I had this at university when I was doing my accounting degrees, because you've simplified that down really nicely. I might just kind of use an example, and Dean will know the example I'm referring to because it keeps coming up. I feel like I've been talking to Dean about this particular example almost for about 18 months now, and that's the concept of a royalty funded arrangement. Now, the royalty funded arrangements are quite common in the um, natural resources, mining, and so forth. That they have been around for a while. The reason why I'm using it as an example is that they seem to be taking on a bit of a life of their own in terms of the actual terms we see. More, they're becoming more common, first of all, and they're also not only limited to the mining and resources sector anymore. I'm starting to see them peppered in other industries as well, which is kind of unusual in a way, but it's because everyone's looking for funding from different sources. So the people with the funding are starting to get a little bit more exotic about how they recover their investments. And one of them is a royalty arrangement where they basically say something like, as you produce, you will pay back our loan, but we'll also take a small percentage of your production volume, or maybe your revenue from your production volume, or maybe even the net profit from the project that we're funding, something along those lines. Now, royalties have been around for a while. The good old-fashioned day royalties are as you undertake the activity that gives rise to the royalty, you accrue the expense and you accrue the liability. And that's a good example of a straight liability. But where things are changing ever so slightly is when you get into these royalty funding arrangements nowadays, and you look at the contractual features of them. So contract, there's a feature, there's a contract. The second feature is that it's not all about only paying the royalty when you produce or when you sell. Sometimes you'll find when you look at the broader contractual terms, is that there really are conditions that exist where the entity is going to pay that royalty out whether they produce or not. And it can often be in situations like during default, or it can be in situations where perhaps maybe there's some sort of condition that neither party controls. And I know Dean's going to actually deal with that slightly later in the presentation. But when you look at the contract as a whole, there are actually other conditions that have nothing to do with the production or the revenue that may actually result in this royalty having to be paid. And sometimes that royalty gets paid in a lump sum, almost as a way to exit the contract. So then you go from it just being a normal accrual liability to actually being a financial liability, because you've got the contractual feature and you've got conditions in there that are going to, be potentially unfavorable to the entity. And so you'll actually recognize in some cases the present value of the liability right from the outset, and now you have a financial liability. So I just kind of use it as an example of how you can go from a liability to a financial liability with the features that Dean mentioned. I just want to say they are complex arrangements. They often require detailed assessments, and the one that I've been working on with Dean literally has been going on for 18 months because the contractual terms are still being, ironed out, shall we say.
Mm. Yeah, and it's interesting. We do see we're seeing on two fronts there. One front is that entities are now talking to us about arrangements that are getting into before they actually sign the agreements, so they have some understanding exactly what their numbers are going to look like. But it's interesting you say that. I don't want to get into that discussion, this particular discussion, this forum, but about how the non-contractual aspects could potentially impact the accounting for these types of
Mm,
things. We don't, in the past, I think we've always taken the view, well, the contract is the contract and that's as far as we look, but now we're realizing, because of the way that entities are dealing with each other and negotiating quite deeply, a contractual term in a contract might have a whole lot of information behind it. And to really only understand how that contractual term is going to
mm,
work, you have to actually speak to the client and speak to the parties to understand exactly what they're trying to achieve and what the likely risks are, and what could possibly happen. So it feels like that financial liabilities and financial instruments has always been a fairly given area, but it is a changing area, and we are seeing a lot of different. I wouldn't say massive movements, but we're just starting to see the edges starting to creep out in the way that people look at these things and how they interpret them. Um, I'll press on. This is probably the second half of this definition is probably the one that challenges a lot of people, and I've gone into a bit of depth in the presentation here to sort of try and assist people in understanding what the differences are. So we move on from a situation where for example, you might have to pay somebody cash to settle a liability. We move on to a situation where you might have to actually issue some shares, your own shares to actually settle an obligation. Now, the definition of a financial liability in AASB 132 actually splits the features into two. So it starts as if it may be settled, and I suppose I will just pause on that one. A contract that will or may be settled. Often we have conversations with people saying, yeah, but I'm never going to settle it. If contractually that the arrangement can be potentially settled in cash, it just allows it. It might not be necessarily economically attractive to do so, but if it does have the capacity, that contractually has the capacity to settle in your own shares, then you actually have to think about this. You just can't assume away that because you're probably not going to actually issue shares that therefore this doesn't apply to you. So if it actually has the capacity to do it, then you have to consider it. And it actually distinguishes between two potential outcomes. So B1, a non-derivative for which the entity is or may be obliged to deliver a variable number of entity's own equity instruments, or B2, a derivative that will or may be settled other than by the exchange of fixed amount of cash or another financial asset for a fixed number of entities' own instruments. Now, it's important because it's interesting when an accounting standard makes a distinction between things, you must expect that when it makes a distinction in a definition, there's likely going to be different accounting requirements applied to those different items. So obviously you need to make sure that you're in the right definition and therefore you're applying the right requirements to ensure that you're actually complying with the standard. So it's interesting, this part of the definition makes that distinction. It does provide some exceptions, and I won't go into those exceptions, but just to flag them, and they're on the right-hand side of the slide there, about halfway down. A contract that may be settled in the entity's own equity instruments and is a derivative is not a financial liability. So this is an exception. So it's not. It's just simply saying, okay, everything that is a derivative may be a financial liability, but these things aren't. these ones we can exclude. One being the contract that may require an entity to settle in a fixed number of its own equity instruments in exchange for a fixed amount of currency, of any currency, i.e. that it may not be the entity's actually presentation currency, if the option to settle in the entity's own equity instruments was offered to all existing holders of the entity's non-derivative equity instruments on a pro rata basis. Now, what would normally make this a liability is the fact that if you are settling in different currencies, there's going to be a foreign exchange risk involved with it. And as a consequence of that, any money that somebody pays you for the shares may differ from the amount of money that you actually think you're going to get, or that you can actually estimate, because you've got a foreign currency translation. Now, interestingly, the standard setter said, look, we're going to look past that feature, because normally we'd treat that as a foreign currency derivative feature. We're going to look past that and say, look, that's an equity feature, because you're treating everybody, you're dealing with everybody, all your shareholders equally on a pro rata basis. So we're saying that that's the defining feature, not the foreign currency derivative feature. That's interesting. It's an exception, but it's probably most relevant to those entities that have got international subs or international investors. The second one, and I won't dwell on it, but it's effectively puttable instruments. We could talk to a whole, we could do a whole hour discussing about puttable instruments, but basically what puttable instruments are they're a bit like equity instruments, but you find them typically in entities that may have been previously a cooperative or a mutual entity, where everyone was involved in the ownership and the production of the entity, and as a consequence of that moving maybe to a corporatized structure, those shareholders, or those individuals that were previously involved in it in the cooperative sense, they have sort of a middle ground between an equity holder and maybe a supplier, and so as a consequence they get a share of profits. And so there is an exception to the rule in IFRS around puttable instruments. They are classified as equity, notwithstanding that they certainly do have features of otherwise would have been a financial liability one. So I'm not going to go into it. Just flag it for your understanding is that there are a few exceptions to this, and once we've got past those exceptions, we can sort of then focus on the actual the definition of a financial liability. The one this is one particular one I wanted to highlight here because I thought it was a great opportunity to talk about it. But it goes back to that I mentioned before about the precision of communications. Often when we're talking about contingent aspects to liabilities, sometimes I do get involved in conversations where people sometimes confuse contingent liabilities with other types of contingent settlement arrangements. Now, we all know contingent liabilities. We usually taught them at university, and they're a common feature of accounting. And the definition is generally well known to people. So it's the idea, and underlying it is, it's as a contingent liability, we don't recognise it on the face of the financial statements. But what we normally have to do is actually disclose something about it, and that's why it's categorised in the way it is. So we say it's a contingent liability. It's defined as a possible obligation, so it's not a present obligation. It's actually a possible obligation that arises from past events and whose existence will be confirmed only by the occurrence or non-occurrence of one or more of the uncertain future events, not wholly within the control of the entity. So it's interesting. Therefore, what we can take away from at least that part of the definition, we can say, well, okay, this is not a contractual arrangement between the entity. If it's a possible obligation, it's not really a contractual obligation. And it's probably more legal or customary in nature. And the fact is that the obligation may not be satisfied by the entity paying cash or transferring financial assets. Again, another distinction from a financial liability. Could involve the entity expending its own resources, staff, inventory, and so on, or engaging someone else to do the work for the benefit of their counterparty. So again, it doesn't have the features of a financial liability. But importantly, I think the need to understand it's not contractually based. The second part of the definition talks about actually ones that are present obligations. So where there is actually an occurring, as an obligating event has occurred, something might give rise to an event in the future that as a result, the entity might have to actually sacrifice economic benefits, but it may be assessed it's not probable that there will be an outflow of resources embodying economic benefits will be required to settle the obligation, or the amount of the obligation can't be measured with sufficient reliability. I can't really think of too many really, really good examples. I suppose the one example I thought of was when I previously worked in a regulatory role, I was dealing with an entity that used to repurpose airplane tyres for tractors. And they were pretty confident in the repurposing process was produced a safe tyre, but they were not entirely convinced that there wouldn't have been maybe some tyres maybe might explode. And so they were concerned about that. So they were always had this notion that, well, look, the obligating event has occurred. We've sold an asset, sold a product that may or may not be faulty. We just haven't heard anything from anybody. We don't have any past history to indicate that there's a problem. But there was always this thing lurking in the background to say, well, maybe there is. They were dealing with maybe a situation where they had limited visibility to where maybe some of the tyres were sold. And so as a consequence, they were sort of struggling a little bit to be able to measure it reliably. That's the kind of scenario where we're talking about a contingent liability. But the important part bit is that it's not contractual. The potential counterparty may or may not do something which might bring forward the liability, might cause, crystallise that liability for your payment. But it's a very, very different obligation to a contractual terms. Now, if we contrast it to, and we don't often, sometimes we do often refer to this section of AASB 132. It's quite a complicated bit, but what it's doing in 132 is actually saying, look, sometimes there'll be actually some contractual arrangements that you'll be involved in, which are going to require you to deliver cash or another financial asset or otherwise settle in a way that's actually a financial liability. That are actually beyond the control of both parties to the contractual arrangement. So, and they give some examples there of a change in stock market index, a consumer price index, interest rate change, taxation requirements, issuer's future revenues, net income, debt equity ratio. So they are financial features or financial variables which are contractually defined and also contractually based, so that if something happens to one of those features, the entity may have to pay cash. But they are not contingently, they're not contingent. They are actually contingent settlement, but not contingent. If one of those things happen, one of the counterparties to the agreement will have to do something. Okay, so it's not a case that there's no contractual arrangement. With these types of arrangements, sometimes people look at them and sort of think that they're contingent liabilities. They're not contingent liabilities, they're contingent settlement arrangements, which are within the scope of 132. And so they have a very different requirement. Again, not going to go into a detail, but I just wanted to highlight the fact that these are a specific type of liability that you need to be aware of, that when you enter them, there is the potential that you have to actually recognise them as a financial instrument or a financial liability. There are some exceptions to it, and they've listed them there. I won't go into detail in them, but keeping in mind that contingent settlement provisions, probably the one that we see the most of is the B one, where there's a contingent settlement provision that says you must pay out in certain circumstances, and one of those circumstances might be where the entity winds up. Now, that's typically treated as if your rights are on the basis of the entity winding up, you're generally seen to be a shareholder in that situation, or in effect a shareholder. And so as a consequence, if you're a shareholder in that context contractually, then we would say there isn't a liability to recognise, because you're actually being treated in the same way as other shareholders, and we don't have liability to shareholders. In respect to the others I mentioned before, puttable instruments, that's one of the exceptions as well. And also the third one, which I'm not going to go into detail on today, but it's unusual, genuine. There can be situations where you look at a contractual term and you decide that it's not genuine. It's a very unusual circumstance. It's not something we normally do, because typically we take the view, and well, certainly I take the view, is that if someone has actually put a contractual term in an agreement, it would be there for a reason. It's unusual for two parties to agree to something that's not genuine. Kevin, I don't know, do you want to add anything to that one?
No, other than to say there can be hundreds and hundreds and hundreds of features. Could be contingent settlement. Going back to my royalty example, once again, very often in the default section or the termination section, there will be things that look like protective clauses that are there. I think the point that Dean made is important. There isn't really this concept of protective clauses when it comes to assessing financial liabilities. If a contractual term is there, it generally has substance. And so just make sure you consider them, but obviously look at the broader implications and the commercials and risks of the contract as well.
Yeah, that's a good point to make too. Yeah, if in terms of financial liabilities, when they're recognised and based on a contractual agreement, then you really have to actually consider the whole agreement as a whole to actually understand exactly what the accounting is. Often the terms, isolating out certain terms and conditions is not necessarily going to give you a good assessment of actually what's going on, and can be actually quite misleading. I've just provided there a copy of, that's from our BDO publication, IFRS in Practice Accounting for Convertible Notes. It's actually quite a good little a good little flowchart that we often use, certainly within BDO, and I know that entities outside of BDO use it as well, because it's quite effective to be able to focus your mind on exactly what you need to think about when you're actually trying to identify a convertible, well, certainly to identify liabilities. It is applicable to convertible notes, but as I mentioned before, we're not going to talk about convertible notes today. We can do it another time. I think, Kevin, you talked with Etienne a couple of years ago about financial instruments. I think you discussed convertible notes in that one, was it?
I think that's right, and we'll kind of just give ourselves a little plug here. So this is a financial liability webinar, but myself and Etienne did one in, I think it was December 22, so it is available on our website, where we looked at financial instruments more broadly. Almost want to say it's a good introduction to financial instruments, and yes, we dealt with convertible notes quite extensively in that webinar as well.
Cool. Cool. So yeah, certainly recommend, if you're in the world of convertible notes, to look it up. I really want to just touch and a very high level on derivatives, because previously the definition of financial liabilities talked about derivative and non-derivative. And again, in discussions with people, often I'll hear people talk about derivatives, and they often think about derivatives as things, but don't necessarily think about them in terms of the accounting definition. So when we talk about derivatives in accounting, we're talking about something that has very specific features, and the definitions there are provided there. So it's got to have all three of the following characteristics. So it's got to have its value changes in response to a change in a specified interest rate, financial instrument price, commodity price, foreign exchange rate, index of price or rates, credit rating, credit. So anything that's a variable, a financial variable, provided in the case of, and now you can get derivatives based on non-financial variables, but those non-financial variables cannot be specific to a party. If they're specific to a party, then they're not going to be derivative. They're not going to meet the definition of a derivative. Second criteria, it requires no initial net investment, or an initial net investment that's smaller and would otherwise be required. So think about when you buy an option over a share. Typically, the option costs a lot less than the share, because there's time and there's variability and there's risk associated with it. So you wouldn't pay the same for a share as you would pay for an option, because the option is not giving you the right necessarily to the share. It gives you the right to potentially be exposed to movements in the value of the share, but it doesn't actually give you the right to the share. And thirdly, it's settled at a future date. And so ensuring that there's some variability there, and obviously that's what creates value in a derivative. Now, I've tried to break down those common characteristics a little bit on the right-hand side there to actually break them and give a better understanding of them. Common features of all derivatives are that they value changes. So you have to be able to demonstrate that somehow, if the underlying value of the underlying asset changes, then the value of the derivative changes. If it doesn't change, then it's not a derivative. The little or no net investment, go back to what I mentioned before, the idea that if you buy an option over a share, you don't pay the same amount as your share, you just pay typically for the risk exposure, which is a lot less than, you don't buy a share, you're paying for something less than the share, but you're paying for effectively the risk exposure associated with the share. And it's settled at a future date, so there usually will be some date in the future where you actually have to either exercise the option or it lapse. So using those characteristics, actually, I just want to touch on this too, maybe to highlight the separate criteria. And I think I mentioned before, all of them have to be met. So if one of the criteria is not met, then it's not a derivative. It's something else. If the value of the instrument changes in response to underlying that is specific to a party, I mentioned before, then it's not a derivative. There is some examples out there where the entities have actually done that, have maybe by analogy have applied the derivative requirements to specific arrangements which have a entity specific feature to them, but that's an accounting policy decision made in the context of the transaction and the particular accounting requirements applicable at the time. So it's not something you'd necessarily always do, and it's not something you necessarily be required or could do in many circumstances. And I just want to highlight too, conversion features that involve the whole instrument being converted into a variable number of shares is not a derivative, because typically what happens is you're getting the same value of the shares as what you basically put into the instrument. And we've got a couple of examples which can help to explain and sort of demonstrate this. So first example, ABC Limited issued a simple agreement for equity, so a safe note, with the following features. So it's got a face value of $1,000, no fixed maturity date, and convertible into issuer ordinary shares in the event that ABC Limited lists on the ASX at a conversion price of 80% of the IPO price. So very, very basic instrument. No other obligations other than, from the issuer's perspective, no other obligations other than to issue shares if an IPO occurs. Now, when looking at the answer to this, so thinking about it, is it a derivative or not? It's not a derivative because it doesn't have a derivative component, because the embedded derivative is a component of a hybrid or compound financial instrument that also includes a non-derivative host contract. Now, in this case, only the whole instrument's convertible into shares, so there's no host contract. Now, when I say host contract, typically what we're doing is it's another feature in the contract that says, and by the way, if, for example, if the IPO never occurs, you get your $1,000 back. There's no such contractual term here, so there's no actual host agreement. The host agreement is just the conversion feature. And so as a consequence, that conversion feature can't itself be a derivative because you paid $1,000 to get that conversion feature. That's not less than the value of the shares. Hopefully that makes sense. Kevin, does that make sense? Cool.
It, yep, makes sense, always does, although I love our conversations when these things come in practice.
The other thing to highlight too is the 80%. So giving a discount to the holder of the instrument if the shares are converted is not unusual, because when you think about it, it's a very simple note that basically says to them, if you hang on to this a period of time, you'll get some shares. Now, if you were an investor, you'd probably say, well, what's in it for me? If I'm converting at share price, why would I actually bother to even buy your instrument in advance, because you're giving me nothing? So one way of looking at that discount is it's sort of like an implied interest earned over the period. In itself, it doesn't create a derivative, because all it does is actually just simply change. It doesn't change the value of the instrument. It just simply it just basically gives the holder a bit of a little bit of gain up front. I think we've got a slide to sort of demonstrate that. So working your way through it, assume the IPO price is $1, therefore the holder receives $1,000 divided by a dollar, or 80% of the dollar, so they get 1,250 shares. If their fair value is $1, I'm getting $1,250 worth of shares. Let's assume the IPO price is $2, therefore the holder receives $1,000 divided by $2 times 80%, so they get 625 shares at $2. They get $1,250 worth of shares. Hopefully you can see from that example is that every time I change the price, the value of the instrument doesn't change, because I'm getting a smaller number of shares, but they're more valuable shares. And as a consequence, really the two things offset themselves. And so consequently, I'm still going to get the same value in shares as I could have got in terms of cash. A second derivative example, again, safe note, following terms, face value $1,000, convertible into the issue ordinary shares in the event that the entity lists on the ASX, a conversion price equal to the IPO, and the face value is repayable in full if an IPO does not occur in 2 years. So this actually has a conversion feature and a host debt. So it's got the host debt in the form of a repayment amount. And so then the question is that conversion feature a derivative? If we have a look at it, it's not a derivative. It doesn't have a derivative component. The reason being the conversion feature is embedded in the instrument, that's in the safe note. But as in this case in example 1, what's actually happening is the conversion feature doesn't change value with a change in the value of the underlying shares. So all that happens is that every time the share value goes up, you get less shares, but you're going to get the same value of shares. And so if you look back at the proof in example 1, you come to the same conclusion. Anything that's converted at the price at a fair value at the time, it will give you a variable number of shares, but it doesn't have a derivative feature to it. So it's a non-derivative feature. Quick last one, GHI Limited issued safe note. It's got a face value of $1,000, convertible into issue ordinary shares in the event that they list on the ASX within 2 years of the issue date. And during the term of the safe note, if the issuer actually issues ordinary shares for less than $2 per share, the conversion price is reset from the $2 per share to the new issue share price. So it's a protective feature we often see in these type of arrangements, that if I'm getting into it, I don't want my interest to be diluted. I'm buying into this instrument in expectation that there will be that I will not be diluted in that process. And one way that entities can dilute things like convertible shares is to actually issue more shares and issue them at a lower price than what you've been issued yours. There is a face value is repayable, and if the IPO doesn't occur, so there's a host debt there as well. So we've got a conversion feature plus a host debt. If we look at the answer, the conversion feature is an embedded derivative liability, so different to the other examples, the first two examples. The value of the conversion feature varies in response to changes in the value of GHI limited shares, and I'll give a proof in the next slide. But as the instrument has a host debt instrument repayable, the acquisition of the embedded conversion feature requires a net investment all on the otherwise. Now, the way to think about that is saying, if you think about it, if you're buying this, you're saying, well, look, I'm getting two things. I'm getting the potential opportunity to convert, and there might be some upside to that, but I'm always going to get my face value back as a repayment. So when you think about if I was to allocate the value of those two things within the note, the face value would have a lot of value to it, and you probably find the conversion feature has a lot less, and so therefore can potentially meet that criteria about a limited or no net initial investment to get the conversion feature. And it'll obviously be settled at some point in time. Again, similar sort of demonstration of the proof bit here, but if the idea is if we assume that they issue some shares at $3 per share subsequent to issuing the notes, the holder will receive therefore $1,000 divided by 2. They get 500 shares. Those shares are worth $3 each. They get $1,500 worth of shares. Same with the $4. Again, they get 2,000 worth of shares, so they're getting more value in shares, but that's because the conversion price is fixed relative to the fair value. Now, if you actually assume that they issue shares for less than the $2, say at $1.50, therefore the holder is going to receive $1,000 divided by the $1.50, 667 shares at $1.50. So those are worth only $1,000 shares. So you can see this conversion feature as a consequence of the way it works. It creates effectively what we call a down round feature, that it creates a floor value. And so as far as the holder's concerned, they're always going to get the $2 shares. But if you actually, if they start to issue shares at a greater price, they're actually going to benefit from that arrangement. So in itself, it has the ability to move with changes in the underlying values. So it's a derivative. Recognition and derecognition of financial liabilities. Kevin, did you want to talk to this one?
Yeah, I think I will, and I might just kind of pause because anyone who does a section on derivative needs a break, so Dean gets a break. Derivatives and embedded derivatives, I think, are the holy grail of accounting advisory because there's complex stuff going on here. But what I will kind of do is just kind of pause and just note that we're 42 minutes into our session and we're really only dealing still with identifying financial instruments and for this session, financial liabilities. So I just kind of want to pause and reflect on the fact that um, the biggest, I think, area of complexity and the biggest area of judgment is often about, do I even have a financial instrument, and by extension a financial liability, and by extension a derivative or an embedded derivative. So please spend time there when you enter into these contracts, because that's when all the good stuff happens, because complexity is all about what is it and how am I going to account for it. And the other thing I want to kind of point while Dean was talking is just to kind of remind everybody that you don't necessarily count for a contract as a single unit of account. Often, actually, contracts are broken down into components and features. So you'll see sometimes in the accounting standards that they don't talk about a financial liability being a contract. They'll talk about a financial liability being an obligation or a component of a contract or a feature of a contract. And what they actually mean is that once you've understood the commercials of the arrangement as a whole and you figured out what the risks are, you'll start to see that different features actually exist within that contract. And sometimes you've got financial liabilities and embedded derivative liabilities and et cetera, et cetera, et cetera. So I guess my point after listening to you talk, Dean, is even if you get the basic definitions and even if you understand the broad context, applying them all at the same time is where the complexity lies. And really take the time to kind of understand that, because it kind of leads to this slide, which is once you know what you have, now you have to recognize them. So now we're up to, let's put them on our balance sheet or put them into our records. And the key concept here is that you recognize a financial liability similar to really any other financial instrument when you become a party to the contractual provisions of the instrument. It's all about the timing. In other words, it's at the start or it's at the beginning. It's not at the end of the year or at the end of the instrument or when you settle it. And probably that's the key to this slide is you don't account for this thing when you settle it. You account for this when you become a party to the contractual provisions, which is also the time when you should really sit down and understand what it is that you've entered into. Actually, no, you should understand what you're about to enter into it before you sign the contract, because at that point we can still help you structure the contract a bit. But once you've signed on the dotted line, the contract is what the contract is, and at that point you've got to do the assessment and start to account for it. Dean, is that in line with your thinking on this one?
It's like you're inside my head, Kevin. That's what
Yeah.
it feels like at this point in time. The number of times, like it's interesting, the number of times when you talk to clients and they say, "Oh, and this is I suppose this is the key part with financial liabilities is that, or any financial instruments, is that often people will take a commercial lens to them and look at the instrument and go, "Oh, that's what it sounds like to me, and I think that's what it's going to look like." And then when they come and talk to us and we say, "Well, actually, no, that's not how it works." That's not how the accounting works. There's often a real difference between the two, worlds, and as a consequence, people can be quite upset and perturbed by that difference. But
Mhm.
it's not, it's got nothing to do with our opinions. It's actually what you've written in the agreement and how the accounting standards are
Mhm.
written to deal with
Mhm.
those things.
Mhm.
So yeah, absolutely agree, completely, 100%.
And following on from that, and this is us having a bit of a debate, so just let's go with it. But a lot of companies will say to me, "Oh, this doesn't reflect the commercial reality." But what's important to understand is that you've legally signed up to these clauses. So the commercial reality of the arrangement often is influenced by the clauses in the contract because it's a risk that you may be subject to that clause. So commercial of a contract does factor these clauses in because you're exposed to the risks of those clauses and therefore it affects the commercials.
Yep.
So accounting for these is not influenced by what you want to happen. It's influenced by what's going to happen or what's at risk of happening or what really the outcomes can be. So it
Mm.
is important that those be considered. I will just kind of throw a few other ones here. Dean's given some examples when he put the slide together about, um, the timing of recognition, a couple of examples about, option contracts. You don't recognize the option when you settle it or when the option becomes shares. It's when you become a party to the contract. So that's from the outset. Often they won't necessarily have a high value at the outset because, as Dean mentioned, with a derivative, there's no or little investment up front. So you may not actually have a starting value, but that doesn't mean it's not being recognized. It's recognized at the outset, and then its value starts to change, and that value needs to be accounted for along the life of the instrument. Um, and then there's a couple of other examples in there about forward contracts as another good example. Forward contracts are derivatives. They have value even if the forward hasn't kind of happened or settled yet. Um, you're committed to it and its value starts to change if it's a derivative. So that value needs to be accounted for from the time when you become a party to the arrangement. So that's the general view. I see you've got one in there, Dean, about liabilities in terms of commitments to purchase goods.
Mm.
And
Yeah.
when you read that one, people always say to me, "Oh, that's a kind of a different exception," but it's actually not an exception because what this one is about is you generally don't account for these things until an entity places an order for goods. Sorry, that you don't account for it until um, shipping has happened or so forth. The concept here isn't an exception. It's actually just another way of interpreting when you become bound to the contractual provisions of
Mm.
the contract.
Mm.
Generally speaking, when neither party has performed under an agreement, you're not yet party to a contract, even if there might be a signature or a purchase order. So please don't read that one as an exception to the rule. It's
No.
interpreting what that means in the context of ordering goods. I have had situations where people have placed orders for goods, and even before they've been shipped, they've recognized it, but that was because the provisions of the contract essentially meant that someone had performed
Mm.
in that scenario. So it was essentially an interpretation of law. When did you become a party to the contractual provisions of the contract,
Mm.
which is really what the principle is about. Yeah.
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 Yeah, I suppose, yeah, and to contrast that, if you're in a dealing with a situation where an entity is making a market, like they're buying, for example, products, commodity contracts,
Mm,
but are actually never actually taking, possession of any of the goods,
mm,
then you're potentially in the world of derivatives, and then you're potentially in the world of recognizing it from day one. So it's
exactly.
context. Context is really important. Understanding, because the context can drive the accounting, which then in turn drives things like
Mm,
obviously like recognition and measurement.
yeah. Right. We might banter back and forth on the derecognition and the modifications. I almost want to say derecognition. I almost want to say once you're in, you're in.
Yeah.
It really is. when you've discharged the liability or you've been legally released from it is when you derecognize it. It's kind of sticky. And the reason why it's sticky is you have a liability or a financial instrument for as long as you're a party to the contractual provisions of the contract. That's kind of the principle. So if you're going to derecognize a financial liability, it really has to be because you've either discharged it or you've been legally released from it.
Yeah.
That's the rules. And
Yep.
contracts
Yep.
can have long lives. There are those clauses in contracts that talk about how certain clauses in contracts actually continue once other parts of the contract have already been satisfied. Those sort of um, indefinite clauses that are there to protect. Sometimes they actually have a bearing on whether you actually de-recognize the financial liability, because sometimes you just haven't actually been released from the contract in
Mm,
various forms.
mm,
But it's not intended that liabilities stay there forever. It's just that you have to be really clear that you've discharged the liability or been legally released from it. That's the rule.
mm. Yeah, and that was a good example recently where the ISB amended the requirements around 9 to deal with scenarios where they're settling financial liabilities using electronic payment systems. So,
Mm,
and the fundamental problem was is that when you pay using electronic payment system, the money does not immediately appear in the counterparty's bank account. And so, from the counterparty's perspective, if it hasn't appeared in their bank account, notwithstanding it's left your bank account, if it hasn't appeared in their bank account, you haven't discharged your obligation. And so to
mm,
deal with that as an unusual feature, perhaps of our banking system, the ISB amended the standards to sort of permit the idea of instantaneous relief, but in principle, you don't. If the money doesn't hit the bank account, then you're not relieved.
mm. Very
I
interesting.
didn't really want to dwell on this one, Kevin. I just wanted to highlight this one as another area where entities
Mm,
need to be really aware of when you
mm,
renegotiate with your banks or other financiers around your arrangements. Different accounting applies subject to what the level and the extent of the renegotiated
mm,
instrument has changed. And
mm,
this is not this is a very judgmental area. It's not necessarily black and white. There's mention there of a 10% rule, but I mean that's there are other features that in a modification which could take you in a different
mm,
course in accounting. It's just not purely the 10%.
mm,
To give you an example, if you change your debt from, you're paying it in Australian dollars and then you're paying it in US dollars, I mean, we'd look at that and go, well, that's a significant change. Why would, if your
mm,
presentation and your functional currency is Australian dollars, why are you changing US dollars? Doesn't that change your liability? Because all of a sudden you've got forex exposure you didn't previously have. So
mm.
it's really important to understand it's qualitative and quantitative. It's not just, it's just not
Yeah,
the 10% rule.
yeah. For
We
those
have,
who
I
aren't
think,
really, oh yeah, I
sorry, go.
just want to kind of say one thing on this one. The modification of financial liabilities, there's lots of guidance out there on terms of how you actually do the 10% calc, and it includes things like how you take transaction fees into account. There's actually some really complicated ways of working the 10% out. My point that Dean was making was also, it's not all about the 10%. That's one of the things to look at. But I did run into an example the other day, which I might just share with you, a very fancy 10% calculation. But halfway through the exercise, I realized that the bank was different. So they weren't modifying
Oh,
existing liability. They'd actually settled with one bank and taken out a loan with another bank. But they were really keen on working out the 10% rule. I'm like, well, hang on, we're not modifying an existing loan. We've literally moved to a new financial institution. So please just stand back before you dive into the 10% calc on this and actually say to yourself, what's actually going on here? And I just found that was kind of interesting.
no, that's interesting. Yeah. Obviously, in big conglomerate banks as well, that could be something a challenge if you're dealing with different parts of a bank or different parts of a financier.
Mm,
Um, Classification and measurement, we can quickly deal with this one, I think. What we typically see in BDO clients and maybe other clients in that sort of mid-market range is most assets tend to be measured at amortised cost, except for those that are derivatives or embedded derivatives in convertible notes. We do see on occasion, sometimes we see that designation at fair value through P&Ls, particularly around hybrid financial instruments. And so a hybrid financial instrument is like a debt instrument that's got a conversion feature that's also a debt instrument. And sometimes with those ones, we do see entities saying, look, there's an option in 9 which allows me to just fair value the whole instrument. I don't have to fair value the derivative and do the amortized cost for the host contract. I'll just do the whole thing fair value because I'm going to get a fair value done anyway because I've got the derivative in there. And as a consequence, we do see that. But there are, when you do go down that route of doing a fair value, designating fair value through P&L for certain liabilities, it does create some disclosure requirements, which we'll touch on sort of later. But typically, we don't see a lot of financial liabilities that arise when a transfer of a financial asset does not qualify for derecognition. And I know that there's been some discussions around that accounting for that to try and understand exactly what's going on, what's the nature of the arrangement. If you don't derecognise the financial liability, what are you doing? Are you actually servicing the debt, or are you doing something else to it? Financial guarantee contracts, which are a bit like insurance contracts, we don't see a lot of those, but you do see them in the context of certainly where maybe parents and subsidiaries guarantee each other's debts. That's a common one that we see. And commitments to provide a loan below market interest rate, again, not a common thing, but you might see it between two entities, like certainly parent subsidiary type arrangements. Typically, you wouldn't see it necessarily so much in banks, but you might see it with related parties within banks, as a consequence of their related partiness that might not transact at market rates. I think we can move on to disclosures, Kevins. What do you think? The examples, I've just plucked out some. The requirements are not extensive. It's interesting. Financial liabilities, the requirements are not extensive, but they do challenge entities. We know they do challenge entities around how to do it. In terms of financial liabilities, basically all of the disclosure basically sit in AASB 7. All of them basically are around tell us about what you've got. So if you have a look, for example, at paragraph 8, it talks about show us what the carrying amounts of your financial liabilities, break them up for designation. I mentioned there paragraph 6.7.1 of 9, which is dealing with, it's sort of like a hedge accounting scenario. Again, not something we see a lot of in the BDO clientele, but credit, it's to deal with credit derivatives effectively, and those that meet the definition of trading in 9. Any other derivative that's not particularly not part of a hedging arrangement, or basically not a credit derivative, would be ones that would meet the held for trading. The other thing that you need to disclose is just financial liabilities measured at cost, at amortised cost. When it comes to the components, and I suppose the one thing I would say, just if you're looking at the right hand side of the slide there, disclosure of net gains and net losses, I mean, it's not just talking about interest. So there may be gains and losses arising on remeasurement of certain things. So as a consequence, when you're disclosing the actual gains and losses, you need to consider that there might be other gains and losses within instruments, in financial instruments, that are not just interest. Okay, so for example, if there's a renegotiation as a consequence of a loan renegotiation, or a waiver of a payment or something like that, that could be a gain or loss that would be included in that line item to disclose. Again, disclosing based on category is a pretty typical sort of arrangement for IFRS, and it's certainly the case with IFRS 7 and AASB 7. More disclosures. These two ones are ones that I find, and the reason I put them in there is because I think that they're ones that do challenge entities, and we do find entities perhaps presenting these disclosures without giving them too much thought. Excuse me. The first one I want to talk about is paragraph 20, 25 and 29. So there's a little paragraph in AASB 7 that says, if the carrying amounts of your financial instruments, so including your financial liabilities, are different from their fair values, tell us what the fair value is. And so most entities look at that and go, oh, look, the carrying amounts are usually approximate fair value, because they're things like trade payables, and they're things that will be settled very quickly. So whatever I'm carrying the amount as, I wouldn't discount it, I wouldn't recognise its fair value movement's going to be not very high. What we do find entities doing is sometimes not recognising the fact that they might have related party transactions, and they might have related party balances that not necessarily reflecting fair value, and so they don't necessarily disclose those. But they might be based on amortised cost, and as a consequence you might go, well, if I'm, for example, doing the amortised cost of a loan at a well below market interest rate, that in itself is not going to be at fair value. So ensure that when you actually have related party transactions and there are balances there, particularly financial instrument balances, making sure that if you do have those, then thinking about that disclosure, you can't simply say, look, we just think it's a reasonable approximation, we think we're fine. The other one, the liquidity, that I wanted to mention as well. So maturity analysis. One thing that I do see a lot of, and we haven't touched on it here, but going concern and how it interacts with the liquidity disclosures. Sometimes you see entities actually doing disclosures of liquidity and not really reflecting the fact that they have also going concern issues. And so there, I've put on the slide there, part C of paragraph 40 does refer to the managing the liquidity risk inherent in A and B. So if you are also a going concern issue and you have this issue that you say, well, I've got more financial liabilities than I've got maybe financial assets to meet them, how would I actually articulate that? Now, part of it would be articulated in the going concern note, but you should also think about how to articulate it in that note disclosure as well, because it'll be very, very highly relevant to the fact that you've got sufficient cash to carry yourself across. Just as an example, I've just plucked out of BDO's global model financial accounts, the liquidity basically analysis they're presented under IFRS 7. I just want to highlight a couple of things in it. Kevin, I might pass over to you. Is there anything you wanted to address in this? No, you're okay. I think the key things I wanted to talk about just here is to say, look, you need to think about, when you're thinking about the categories, use your judgment to determine the appropriate number of time bands and the amount and the distance of those time bands. And they would be reflective of your normal operating cycles and various other things. So if I'm dealing with trade and other payables, if, for example, if they're paid within 3 months, then up to 3 months is probably a good bucket to start with. If they're paid within 3 months and you used your first bucket was 12 months, that might be more difficult for people to understand, particularly if you have them that go over the 3 months. When determining the remaining contractual maturities for financial liabilities, be aware that if the counterparty has a choice, when the amount's paid, the liability is allocated to the earliest period payment may be required. So if you can't stop the counterparty requiring payment, then you need to allocate that payment to the earliest period to be paid. And when an entity is actually committed to make amounts available in instalments, each instalment has to be allocated to the earliest potential period. So it's really trying to bring everything and being realistic about the way that you contractually, because keeping in mind is contractually, if you can be forced contractually to pay certain things, you can't simply say, yeah, I'm not, contractually, yes, I'm going to pay within 3 months, but hey, I know that they're going to require it within 6. That's not how this disclosure works. It's trying to actually, consistent with the notion of a financial liability, it's actually trying to disclose what the contractual obligations are. The other thing, probably the other key thing I wanted to highlight there is at the bottom of the green arrow. It's not unusual to see entities meeting a particular disclosure requirement in AASB 16 for the leases standard in this AASB 7 disclosure. But when entities do that, they need to be aware that AASB 16 does say that if you provide or you meet any of the disclosures required in respect of, for example, leases outside of the specified note for leases, you need to cross-refer so people can find the information. That's another thing we often see people don't necessarily always address when they're preparing their financials. Probably last but least, and I don't want to dwell on this one too long, but I suppose the key one, and I wanted to just highlight on this, is that if you do, and I mentioned before the idea of designating a financial liability at fair value, if you designate it at fair value, as a part of the fair value calculation, there's likely to be included in that measurement some counterparty and own risk, so own credit risk. So the idea that you potentially might not actually be able to meet your liability. And so if that's actually included in the valuation, that actually has to be separated out and disclosed separately. So for a lot of entities, it's attractive to go down the route of saying, I'm going to get the whole financial instrument, fair valued, because I was going to have to get the derivative part fair valued, but I'm going to get the whole lot fair valued. If you go down that route, you need to be aware that there's a bit of extra work around the credit risk and making sure that that credit risk is actually correctly disclosed in your financials. In terms of assistance, this is where we plug. Obviously, for anyone who's listened to this before, we do, basically we have 3 pillars of services. We have lease accounting management services, we have IFRS advice services, and we also have sustainability services. So I'm going to plug the leases and the IFRS, and I think Kevin's going to give the sustainability a plug. We're still finding people coming to us. I don't know how long we've been doing lease accounting. I think I've been with BDO nearly 7 years, and it was going when I arrived. So over 7 years, we've had people, we've been providing services to people on lease accounting, and we're still finding people coming to us. And the fundamental reason is that lease accounting, as you get further and further into it, as you get more and more leases, it gets more and more complicated and time consuming, and the value proposition is just not there. So if you are in a situation where you're starting to think that this lease accounting has got a little bit more than just hair on it, it's starting to be more challenging, please do come and talk to us, because we have excellent technicians who can actually assist you with it. We've obviously got our regular insights, the corporate reporting insights that you can all subscribe to. I certainly know I saw the draft articles going through yesterday, so some interesting stuff that's coming through in the next and has been in the past. We also have our reporting hub, so in terms of learning hub, online courses, not unlike this one, but obviously on specific topics that are quite helpful to people, particularly if you are trying to upskill on a particular type of topic or in a particular area. From an accounting perspective, it's actually very helpful. In terms of the IFRS and corporate reporting, so the actual advice, we've got technicians right around Australia. Obviously, we've got Kevin in Sydney, myself and a letter in Melbourne. We've got Lynn in Adelaide, Ashley in WA in Perth, Clark in Brisbane. I think that's covered everyone. All available and all capable of actually assisting you with any kind of accounting advice that you require. I might hand over to you, Kevin. You can be on sustainability.
Thank you, Dean, and thank you for leading the discussion today, Dean. It was always good, and I'd like to say that it put some things into perspective for me again as well. So it's always good to revisit some of the old topics. In terms of sustainability, just a reminder that we have a broad range of sustainability. It's not all about reporting, although it is the primary driver at the moment for a lot of organizations in terms of climate readiness. So carbon accounting, the sustainability reporting, right from helping with climate risk analysis all the way through to drafting reports. We're kind of doing it all at the moment. But bearing in mind that extends to our assurance practice as well as our strategy and transformation team, who can, help with a variety of broader transformational projects across the spectrum. And we have put the key contacts in here as well on the next couple of slides. But I think if you don't know where to start, then come to myself in Sydney or a letter in Melbourne, or really anybody else in your local office, and we can direct you to the right place from that point. These are our advisory partners, and then we do actually have a separate practice on the assurance side, obviously because there will be requirements for assurance. And assurance is not just the report, it's also ENGA audits and a variety of other assurance activities. I'll leave it at that to you, Dean. Thank you very much for this, and thank you to our attendees. See you next time.
Yeah, thanks, Kevin. Thanks, everybody, and see you next time. Cheers.
Cheers, bye.